Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us here in this busy time of the year. We've got a couple of topics to go over with you today. We're going to talk about real estate and why that really has our focus. And then Andrew's going to cover risk appetite, something that he's constantly monitoring and periodically shares in the investment meeting when it's forming trends one way or the other. We'll kind of look under the hood on what that means and what it might mean to you more specifically. So we'll start on the commercial real estate side. And what we're looking at here is a relative valuation between public equities and public or commercial real estate. So we're looking at specifically PE ratios between the two, and you're looking at the equities and the numerator and commercial real estate in the denominator. So when this chart is rising, that means that investors are willing to pay more and more for stocks as opposed to real estate, or conversely, when it's going down on the inverse, that means that commercial real estate is becoming more expensive relative to equities. And you can see it's not static over time. They're both risk assets, but at different times, investors can favor one or the other. And for you engineers or statisticians, we are quoting these here in terms of z-scores, so standardized. So 0 would be your average, and 2 and 3 up there would represent standard deviations away from the more or really unusual. So if you look at this slide, going back into 2007, right, as we had the housing bubble peak, there was just tremendous interest, not only in homes and second homes, but commercial real estate as well. Investors just couldn't get enough, and they pushed valuations to where they were really expensive relative to stocks. And now we find ourselves in the converse of that. In fact, we've seen major institutional investors be bigger sellers than buyers of real estate over the last 3 years. And as you know, stock price is something we've covered several times. Valuation measures have shown stocks gone very much to the expensive side, no matter what metric you're looking at. And here, obviously, on the PE side. So the ratio between those two is now 3 standard deviations away from normal, which is something that rarely happens through time. And real estate can be a different and a unique situation because it means something different for everybody. Everybody has different tax circumstances. They've got different portfolio and liquidity needs. So this is a one-on-one conversation, and many of you have had that. And this is the reason why it's become even a bigger focus for us here going into next year, because we think that could really be an asset class that delivers, what you would normally have as equity-like returns if you make the right investments in that space. So that's the real estate slide, and we'll move it over to Andrew and talk about risk appetite as promised.
Thank you. So when we talk about risk appetite, what we're measuring there is looking at different corners of the market and looking at things that should be rising or outperforming their counterpart. When we start seeing investors' risk appetite, when they're starting to chase after equities, they're wanting to take on more risk, things like that. Some examples of that is typically we see offensive sectors outperform defensive sectors. We see certain commodities start to do better. We start to see small caps begin to really shine. We begin to see things like high yield debt do really well. So we look at all these different ratios of relative strength, and we start to put them in a composite. What we're looking at is how have they done over the last year, and where are they within their 1 year range? Throw all that into a computer system, and it spits out this chart that we have on the screen here today. What this is telling us is this line is going down. It's suggesting that based off different market data sets, that risk appetite's declining. And we saw that back in April. It got really, really low, a multi-month new low, as a lot of these risk ratios got to the lowest level they'd seen in the last 12 months. Since April, we've seen this begin to climb higher. We really try to evaluate, is it above or below 50? Meaning, are we starting to see risk appetite in the upper half of its 1 year range or below its lower half of its 1 year range? Here recently, why we started talking about this in our allocation meeting this week, if you look to the far right side of the chart, we had started seeing risk appetite decline over the prior weeks. We started seeing investors, based off this data, less interested in taking on a lot of risk, a lot of equity exposure. And that changed in the last 2 weeks. We saw this really start to move higher. Actually, we're seeing it now at one of the highest levels for 2025, as we start to see a lot of chasing into high beta type sectors, we start seeing some growth and really see a lot of that kind of FOMO, fear of missing out type trades coming across our screens. And this lines up with what we typically see at the end of the year. We often see investors begin to chase performance into year end, get a little bit excited, or maybe they're trying to play catch up. And so we are seeing a lot of that in a lot of different corners of the data, suggesting we are seeing investors really start to get more bullish. And this is typically a positive for the market. When we start seeing investors want to own more equities, typically we see equities start to do better. So this is one of the pieces of data that we have that actually is encouraging for equities, encouraging again for risk appetite for owning stocks and risk type assets. So we'll like to see if this continues to play out through the end of the year and into January. But as of right now, we are starting to see the data turn more positive.
Yeah, excellent. Thank you, Andrew, and thank you to all of you for giving us a few minutes of your time. As always, we sure do appreciate it. If we can be of service in any way, please don't hesitate to reach out. 800-928-4001. Scan the QR code and do it electronically. Thanks again, and have a great weekend.